Hello, I am Dennis Nachi, a partner at Lawberon Legals Co. Today we are conducting a definitive masterclass on corporate tax compliance in Nigeria. We will dissect the 4 pillars of corporate law taxes, which include company income taxes, value-added tax, withholding tax, and the capital gain tax. Go beyond the headlines and give you the specific sections, the new rates, the precise exemption thresholds, and even the documentation and compliance path that you can take to be fully compliant. We'll also point out for you the documented consequences of non-compliance. By the end of this briefing, you will have the detailed knowledge required to lead your organization or company through the new tax regime with confidence. The new regime is built on 3 pillars. First is registration, we have calculation, and we have remittance. So let's break down what has changed for each of these pillars. First is registration. And you must note that every company operating in Nigeria must be fully registered with the Corporate Affairs Commission and must obtain a tax identification number from the FIRS for the purpose of tax remittances. So this isn't new. However, what is new is the level of interagency data sharing. The CAC, the FIRS, the banks, and even the immigration services are now so much interconnected that there is now so much need for your corporate records to be consistently perfect across all platforms. What does this mean? This means that ensuring that your business registered address is current and that your annual returns are not just filed, not just with the FIRS, but also with the CAC, because a lapse in one can now trigger a flag in the other system because of how data is now being shared and interconnected among these government agencies. For foreign-owned businesses, these requirements are now stricter. You must have a physical and verifiable address here in Nigeria. Furthermore, your expat staffs, like the expatriates under your employ, must all obtain a tax identification number and must duly and timely remit their personal income taxes to the FIRS or LIRS as at when due. Now, this is important because all these data will be cross-referenced with their work permits. The era of brief business visits will now be more scrutinized. So it's advisable that for foreigners or foreign invites into the country, either from your company, people you're inviting for business visa or with business visa, should not take up working roles for the period of their business visas. With the registration part done, now let's jump into the second pillar, which is calculation. What are the new tax rates? This is where the financial impact is most directly felt. We would discuss the core taxes and the rates you must know for each and every one of them. Now let's begin with the primary tax every profitable business must pay in Nigeria. That is the company income tax. That is the CIT. What is the CIT? This is tax that is levied directly on your company's annual profits after all allowable expenses and capital allowances have been deducted. The rates for these taxes are as follows. Prior to now, big companies or large companies have the tax rate, CIT rate of 30%, and it has not changed. It still remains the same. However, what we used to have as the medium class, as the medium companies that had the threshold of between 25% to 100%, has been wiped away. Like it's no longer existence. Now there are no more medium companies in the categorization of the new tax regime. So what we have now is just the larger companies with annual turnover of above 100 million naira, and then small companies have seen their threshold increased from 25 million naira less in annual revenue to now 100 million naira. So now that's a whooping big gap and incentive that is targeted at encouraging small medium enterprises by exempting them from paying corporate income tax. So the CIT rate for small companies, which are companies that have annual turnover of less than 100 million naira, and fixed assets of not less than 250 million, fixed assets of 250 million naira or less is now 0%. So for companies like that, there's no taxes for them. There's no company are not due to pay companies income tax. However, this is a great incentive. It is only available for companies who are or businesses who are compliant. So you need to structure well and make sure that you are compliant so that you can be able to benefit from these incentives. This is a significant incentive, but it is only available to fully compliant businesses. So we also have the global compliance game changer. That is the 15% maximum tax, 15% effective tax rate for multinational companies. So for multinational groups with global revenue of over 750 million euros or 50 billion naira in annual revenue, any of their Nigerian entities whose effective tax rate is below 15% now has an imposed top-up tax that they must meet up with that 15% as the global standard rate for any of such entities that are affiliated or that are subsidiaries of a multinational group of companies which annual turnover is more than 50 billion naira. This is a way for the government to make sure that however you're able to make 50 billion naira as a company or as a multinational company in Nigeria or outside Nigeria. So far you have an entity here in Nigeria, you must top up your tax for each of those individual subsidiaries to be minimum of 15% effective tax rate. So this is for the big guys. This requires financial planning, and it is a clear sign of Nigeria's integration with the OECD's global tax framework, which is applaudable. Next on our list is the capital gain tax. Now, what is CGT? CGT is the tax on the profits you make from selling your chargeable assets. Now, what are chargeable assets? Chargeable assets includes real estate, stocks, bonds, and even business equipment. So for context purposes, it is not a tax on the sales price, but rather on the profits you made from the sale itself. So you have to calculate the difference between what you sold the property or asset for as against what you originally bought it for. That's the value you bought it for. So the rates now have dramatically changed. It used to be 10%, but now the CGT rate now is 30%. Let's say, for instance, your company bought an office building, let's say for 50 million naira last year, and later sold it for like 80 million naira. Now the chargeable gain tax will be on the profit. That is 80 million minus 50 million. That is your profit now is 30 million. So that 30 million naira used to be, or supposed to be like 10% of the 30 million. That's like 3 million naira. However, with the new rates, you are now expected to pay 30% of that profit. That is the CGT. It's now 30% of the 30 million. That is, instead of 3 million, you're supposed to now pay as 9 million naira as taxes for that singular transaction. That is one of the highest whooping changes we have seen in the new tax rate that has been established by this new tax regime. Something to take note of when you are considering disposing assets for your companies, any chargeable asset in any manner, and then when considering mergers and acquisition, it's something you need to take note of when drafting your valuations and model plans. The Third on our list is the value-added tax. Now, what is VAT? You must have heard about VAT. VAT is an indirect tax applied to the sale of most goods and services here in Nigeria. As a business, you act as a tax collector on behalf of the federal government, expected to collect the VAT on such goods and services that are vatable and remit same to the FIRS. Now, what we will now have as the NRS. So you charge VAT to your customers and remit same to the FIRS. Now you can also claim back the input VAT you paid on your business purchases. So this now reduces the total amount you are due to pay as taxes for your CIT. So this is a new enforceable change that can benefit business owners, because now you can claim back input VAT. The rate has been stable at 7.5%. There has been no changes by the new law. However, what has been changed is the administration. It has just been revolutionized with the introduction of the e-invoicing. Previously, you would calculate your VAT at the end of the month and file a VAT return. Now, with the mandatory e-invoicing system, for many businesses, every time you issue an invoice, the data is sent directly to the FIRS portal and in real time. So this means that the tax authority now has instant visibility to your revenue. So there's zero room for errors, and there can no longer be delays in remittance, because the FIRS is seeing when these things are coming in, because they are getting real-time reports because of the e-invoicing that has now been mandated upon businesses. So this is a new one that businesses will have to adapt into. For businesses who used to use just maybe Excel sheets or even hand paper, you may now need to transition into the e-invoicing compliant record-keeping books, so that you don't fall prey to penalties. Because now, in recent time, there has been a case between the MTN and FIRS. That recent court case clarified the application of penalties on VAT remittances. The judgment underscored that once a VAT liability is established, automatically failure to remit it triggers penalties and interests. Now you may ask, what are the penalties? The penalties is a whopping 10% of the due taxes, and then the interest starts accumulating as immediately as possible and must be interest at the CBN prevailing interest rate as at whenever this penalty started accruing. So with the e-invoicing, the time of establishment of the VAT is now instant. As at the time you are sending the invoice already, it's sending signal to the FIRS portal that this invoice. So the time of establishment is instant. If you do not remit as at when due, penalties already start accruing and interest follows suit. No more grace period of, okay, let me compile my taxes and then I'll forward them to the FIRS. Even the internal sorting out of errors is not even available to you, because as a business, you are sending the invoice to your customers, you're already sending the details to the FIRS. There's a stricter burden on businesses to be more meticulous in preparing and sending invoices. Those errors of sending even pro forma invoices that are not entirely correct are now going to be so much detrimental on businesses. So there's now need for you to not only just use and adopt the right tools, but also for you to train your staff well to be able to not fall prey of the new invoicing and mandatory rules. Otherwise, you risk a lot of penalties and instant accruable interests. Now, the next is the withholding tax. What is withholding tax? Withholding tax is not a separate tax at all. Rather, it's an advance payment of an income tax. This income tax is the income tax of the service provider who is providing service to your company, to your business. As a business or as a company, when you pay for specific services, like professional services, rent, and construction bills, and even licenses, a whole lot of them. You are expected to withhold, that is to deduct and withhold the tax, the income tax that is due for that payment, and remit it as tax on behalf of your service provider to the FIRS. So it is your duty to deduct that advance payment of tax, and then do what? Give a withholding tax credit note to the service provider. So what this does is that with that, the service provider can now take it to now claim tax credit from and when he's trying to file his company income tax. The provider then is to receive, the provider of that service, that is the service provider, is to receive a WHT credit note from you, which they can use to offset their tax liability, that is their final CIT liability, at the end of the year when they are calculating their own taxes. So for the rates of this typically varies depending on the transaction type. It's either 5% or 10%. So the old and the new rates, there's actually not much difference. There has not been any changes in the rates. However, what has changed is that there is now stricter enforcement and stricter documentation requirements by the FIRS. So this is a critical point for foreign businesses. So imagine you're a Nigerian company. Let's use for an example. A Nigerian company pays a software firm in Ireland, let's say 100,000 euros for a license, for you to license the software you are using from that company. So you must withhold 10%, that is a 10,000 euros from such payments, and make the payment of 90,000 euros. Make a payment of 90,000 euros and remit that 10,000 euros to the FIRS. What you now need to do is to provide that Irish company with a WHT tax credit note. It is with this credit note that the Irish company will now use to show to the national or home internal revenue service that, oh, I've made this tax payment already in Nigeria, so that he can be able to claim tax credits with that credit note you have given him, or he will risk being double taxed. Now, proper documentation will now be factored in, as perfect execution of this process is now very critical in maintaining relationship between your company and your international business suppliers, and even the ones here in Nigeria. So now we head on to pillar 3, that is the remittance and documentation. Getting the calculation right is just one half of the battle, while remitting the correct amount and on due time with the right documentation is the final step. So the statutory deadlines now still remains that CIT is to be filed within 6 months after the end of the year, end of your financial year as a company, while VAT and payee remittances are to be filed monthly to the FIRS. Furthermore, we must know that when repatriating profits, foreign companies will be asked for their tax clearance certificate. The FCBM will ask for these things before they can approve repatriation of profits back to their home countries. Tax compliance cannot be overlooked at this stage. Under the new regime, we expect that the verification of these documents will now be so easy and seamless, and will even be much more implemented, since there's now so much data sharing between the government agencies. Now, what are the consequences of non-compliance? The new Nigerian Revenue Service aims to create a more powerful tax authority. The penalties are outlined in the FIRS Establishment Act. The penalties that are outlined are no longer just theoretical. Because first of all, we have the financial penalties. The penalty standard rate is at 10% of the tax due plus interest. Now, this interest is based on the CBN official prevailing rate. Financial penalties. The standard penalty is at 10% of the tax due plus interest at the prevailing CBN rate. So let's say, for example, if a company has a 1 billion tax liability, now that's an immediate 100 million naira in penalties if they do not remit as at when due. Another consequence of non-compliance is the asset seizure or account freezing by the FIRS. The FIRS has broad powers to freeze companies' bank accounts in order to be able to recover unpaid taxes. Now, there have been several high-profile cases where major corporations had their bank accounts frozen. During these tax disputes, their bank accounts were shut down temporarily, and this affected their operations. This is not a place to be for any company, so it is advisable that you do the needful and be tax compliant to avoid certain disputes. And wherever there's any chance of discrepancies between what you feel you are due to pay and what the FIRS is saying that you are due to pay, it is best to quickly reach out to a tax professional and instantly engage the FIRS so that you avoid instances of having your bank account being frozen, as that can affect your operations as a business. As you can see, the new tax landscape is defined by higher rates on certain transactions, like the CGT, deeper data visibility for tax authorities, and even stricter enforcement due to the documentations that have been introduced by this new tax regime. For example, the e-invoicing and all that. So the message from the government is very clear that compliance is no longer negotiable. It's not optional anymore. It's a whole coordinated government move and approach. However, within this stricter framework lies opportunities that can be taken advantage of for optimization. So the new law includes incentives to specific industries and more generous capital allowances. The increased SME exemption threshold to 100 million naira allows larger companies to do business more efficiently with smaller tax-exempt suppliers. So navigating this requires a proactive approach that has to be strategic. It's no longer like the way you handled it last year. Now it's about structuring your operations in a manner that it can capture the reality of the next 5 years. So a reactive year-end approach is no longer viable. Now, proactive and strategic tax structuring has to be integrated in any major business decision you're about to make as a company, both from asset sales, M&A, to your choice of suppliers, both international and local suppliers. Because with choosing the right suppliers, you can avoid some of the VAT remittances. This is where expert guidance becomes your most competitive advantage. So it's nothing to be overstressed. So the transition to the new regime requires instant and quick moves from company and business leaders. You need to review your corporate structure, your accounting systems for e-invoicing readiness. Are you ready? Your financial models for the new CGT rates, have they been readjusted? Then, whether you're a foreign entity entering Nigerian markets or an already established domestic business here in Nigeria, now clarity is one of your greatest assets at this point in time. So this is not a task for your internal account department to handle all alone. It now requires legal and tax expertise to ensure your structure is not just compliant but fully optimized to take advantage of all the incentives that has been rolled out by the new tax regime. Note that at Lawberon Legals Co, we serve as strategic business partners so that our clients are not just compliant but are structured forward for optimal advantages in this new tax regime. We handle the complexities so that you can focus on the core of your business. So we invite leaders of forward-thinking companies, organizations and institutions here in Nigeria to schedule a corporate tax and compliance review with our senior partners. This is a confidential high-level session aimed at stressing out your current tax postures against the new laws and to build a clear roadmap for easy adaptation. We invite leaders of forward-thinking companies, organizations, and institutions to schedule a corporate compliance and review sessions with our senior partners. We look forward to see you on that call. If this video was valuable to you, we welcome you and we urge you to share it to other business owners or leaders like you who you feel may need them. So hit the like and subscribe button so that you're able to get some of these briefings that are targeted at business leaders who operate and run businesses here in Nigeria.